Hey everybody, Preston Brent here with our free weekly roundup. This is for the trading week ending January 15th, 2016. What a crazy start to the year. If you are a member of our group, none of this should be a surprise to you. In fact, we've been watching the markets and having some really good short-term trades here recently. With the big wild swings that we've been seeing. We've been calling intraday moves up and down, so we've allowed our members to play both to the upside and to the downside, and we've been pretty good with our calls thus far. And I believe this kind of opportunity, or this kind of market environment rather, creates a great opportunity for short-term traders, swing traders, and even day traders. It's just a great market. For the option trader, it's also very good. Let's kind of break this market down so I can show you where I think we can go and what we can possibly expect here. And when I say that, I don't mean with 100% assurance. No one can give you that. If they say they can, then run as fast as you can the other way. But I give you a higher probability of where I believe the markets are going to go based on current price action and volume. If we look right here, I got the S&P 500, the SPX, that's the cash index. So it closes at 4:30 in the afternoon, and then it opens again at 9:30 in the morning, both times New York City time. So if you can look at this, what I've got drawn on the screen here, let's just move it out just a little bit so that I can show you. Now, I showed this to you last week, but I'm going to show it to you again because I think it's very, very important. And in times like this, in higher stress, it's really good to just take a step back and just see where we've been and where we're going, where we are now and where we're going. You can see that from the March 9th lows to the approximately May 2015 highs, and you may not be able to read that number, but it says 2134, and this is the SPX, roughly, not quite, 2137, I believe. But what we've got here is a secular bull market. We're clearly, if you were to just eyeball that chart, say, yeah, you know, we're definitely in an uptrend. You can see the dot-com bubble highs, the 2007 highs. Then what I've done is I plotted a Fibonacci on this chart from the lows of March 9th, 2009 to the highs made last May in 2015. And now you can see this pullback, but it's created here for us some really good key Fibonacci points. Now, this is all well and good, and it'll show you just some general possible pullbacks. You'll notice the first one's not a true fib number, but I love using it because it's very accurate. And it tends to be in a very stronger bullish market where retracements seem to go. In this case, it'd be a counter trend move to the secular bull. And that would take us down to about 1791, as you can see right here. And that is just a 23% pullback from these highs here. Now, that does not mean a 23% pullback in the S&P, just a 23% pullback from this range right here. Remember, an official correction is defined as a market that is greater than 10%, okay? An official bear market is greater than 20%. And I'll show you in a minute where we stand. But you can see this secular bull like this. We can pull back to here to still be in a secular bull, but have a correction going on, which is where I think we are at this point in time. An official bear market can happen without the economy being in a recession. And for those of you policy wonks out there, we like to trade. We could care less about it, but it's nice to know because it creates more fear and greed for us to profit from. But an official recession is 2 quarterly back-to-back GDP numbers sub-zero. I don't think we're going to get it. I think the forecast right now for Q4 GDP ranges anywhere from 30 basis points or 0.3 to about 0.9. So it does look like it's going to come in dramatically from Q4. The markets are pricing that number in. But this is kind of where we're sitting right now. The other thing I wanted to show you on this chart is keep in mind that we can come all the way back down to the first official fib node, which is 1576, okay? And we could still be in an official secular bull. and that would give us a pretty good fallback. And you could see it was resistance here in the dot-com bubble in 2007. So in looking at this rocket ship blast up, a little bit of chop like that, uh, finding some support and then moving up, to me, is entirely doable, entirely believable. This will be our line in the sand number right here. If this number holds, then I believe we're going to see a lot of buyers somewhere between the 1790 down to the 15, let's call it 76, 1580 area, coming in and starting to get a little bit more confident. But I would not be surprised at all if the markets hit 1576. Depending on how China handles their yuan currency devaluation, depending on how low oil goes, oil right now is highly correlated with the equity markets in the move, is going to determine, do we come down to this number down here, or do we kind of find support here at this 1790 area? Okay, that's a little bit about where I'm calling the range right now. As we go forward in time, I want to see how we handle next week, a holiday shortened week for the U.S. markets. As a reminder, the futures market is going to be open Sunday night at 6 p.m. New York City time, and the futures market will close Monday at 1 p.m. New York City time, 12 noon Eastern Central or Chicago time. But the equity markets are closed all day. Meanwhile, all the other markets internationally will be trading. China comes out with their GDP number for Q4 Monday night. Chinese markets open at 8:30 p.m. New York City time Monday. Watch those openings, folks, because China has been roiling the market, and we've been playing the Chinese market using the S&P 500 futures as a proxy near term. Why? Because it works and it's making money for us. So we do it until the correlation stops. It'll never be like this all the time, but we take advantage of what the market gives us. Now, looking at this market here, to define an official bear market, we're going to come in here. Let me just string this out just a little bit. I'll widen it so you guys can see it just a little bit better here on the screen. You can see here on this weekly chart. So let's move it to a daily. Just to zoom in just a little bit here first. And I'm going to show you here, if we look at this chart here, and let's just kind of get both of these fib numbers set right here like that, okay? So now if we come in and we take a look at the pullback, where are we going, that kind of thing. We come from the highs here and we come down to kind of where we are right now, which is right around here roughly. That's from the highs. So we're down from the SPX highs 13.02% off the highs. We still have a ways to go to make the to make an official bear market. Just to show you where we got to go that would make it an official bear market, we'll leave this on the screen here, and this will be plus or minus 1% because my number, as I draw these lines here, it's a little bit tough to get it exactly accurate, but I'll leave it right there at let's just, oh shoot, let's get it back down again. All right, so we'll call it right there 20% roughly. That puts us right around 1700. Okay, so if we get down to 1700 in the SPX, and remember, I called 1791 as an area where I would expect to see some consolidation in the market. Okay, this will be our first really true test. If we break this area here, then we can expect in all likelihood a bear market, because we'll come down to the 1700 level, which is also a psychological barrier, and we'll test that and probably flip over into a bear market. If we come down and test this area right there, 1791, it's not a bear market, folks, but what it would do essentially is give us let's see, let's just do another just to kind of see what it'll give us as far as a pullback goes. If I were to move it here like this, we'll just move them over here just a little bit, just to kind of get them all even up here like that. So get them down here like that. So if we were to come down and say, gee, what would that be down to that point there roughly? it puts us right around 16% down move. So that to me is very believable. And looking at the price action, this is kind of where we are. This is the believable number, 15.84, and bear market territory, 1700. Now, I'm going to go back out to the weekly chart again. I'm going to leave those lines in there, and I want to draw a couple of other lines for you guys. And I'm going to actually, I've already drawn them, so let's put them in here like this. Let me just put this on here. Now I've added a couple of key lines here, and you're going to notice a couple of things. The first channel is this line right here and this line right here, okay? So we got these two right here like that, and we are right now just slightly below this first channel, right? Just slightly below. That's kind of where we're sitting right now. This second channel is really just a lower trend line right there. You'll see that it takes us right there to that point at 1791, the fib pullback, just about exactly on there. If that channel breaks, we're going to go into bear market territory, okay? That is my current belief, my call based on the way the markets work. So if I go back to a daily, I just wanted to define those lines for you. Let's blow it up a little bit. Let's take it out. And you can see right here very clearly, I've got this channel right here, which is what I talked about, okay? That if we fall, and that should provide support for us. That's another area of support. That would be what you call congruency. Congruency meaning we got the fib number lined up there with a typical percentage that I'm looking at right here that I can see is a high probability stop for us. So that would be our near-term stop, and then I would expect to see some lift. Notice I've also drawn in here another channel that we're starting to play now, and it goes off the screen, but you can see this channel here. This channel, my lines aren't exactly right, can take us into this area here. You can see the height of this channel right here. Like this, and then this channel right here. Now you can do all this with Gann, Fibonacci. I try and keep it simple by just showing a few lines on the screen, but that's a key number, and then that is the bottom of that channel. That's a key number. We break this channel, this downward channel, then we go into bear market territory. We break this upsloping channel right there, then we test, are we going to turn into a bear market or not? So we've got two levels right there at level 1, sitting right at about 1790, and then level 2 that divides bear market from not, sitting right around 1700, plus or minus 10 points or so, just because my numbers aren't exactly right the way I just hand drew them in here. But it gives you a good idea of where we can expect this. So we can do one of these numbers, get a lift like this, come back down, up, down, and then boom, we're here. And what happens is an up move like that is what suckers everybody in. Until we can clear our opening price of the year of 2016, around 2038, that's that blue line right there, the opening price of 2016. Until we can clear that, then we got to be very wary of any up move. I mean, just very, very careful. Now, let me just get all this off the screen here. And let me go back to the chart, and let's just look at, I'm going to zoom in a little bit more, and let's look at the daily bars here so that you can see them a little bit better. And let me just show you a couple of these things here. Still, we're staying with the S&P 500, SPX, the cash index, okay? Let's just zoom in so that I can exaggerate this a little bit just to show you the daily action. All right, now, if you look at this, this was Wednesday, Thursday, Friday, okay? Now, look at Wednesday. We opened, we made a new high. That was a bull trap. It suckered people in because we took out Tuesday's high, and then we closed right at the bottom. I mean, it was really a sucker's bet right there. And boom, we just took it out. That was when we were shorting the market on Wednesday for you day traders and short-term traders. Market moved a lot. Then another sucker's bet. We opened right here, made a new low, suckered in a lot more shorts, and look at what we did. We went way up here and closed way up there on Thursday. A huge reversal. But notice we didn't make a new high right here. We stayed at a lower low. So that was a sucker's bet on the bullish side. And I told folks, be ready for a rollover. And then it opened right there, and right at open, we came all the way down and made another lower low, and we closed off the lows, very similar to where we closed on Thursday. So these three candlesticks right here are just perfect for the short-term trader, where you want to get in today, get out today, or get in today and get out tomorrow, the next day. I mean, there's just great trades for you short-term traders over Wednesday, Thursday, Friday. And, you know, when the markets get displaced like this, we want to take these kind of trades because the probabilities are in our corner, because the markets tend to run very fast. Right now, most of this move that was made right here on Thursday's bar was a lot of buy stops being covered by all the weak short hands in the market, right? You know, they got short on this move down here like this. A lot of people got short, and they go in, the markets go down lower, so more people jump in shorts, and then boom, the market starts going up, and all those shorts start triggering buy stops, runs it all the way back, and we close near the highs, but we didn't take out Wednesday's highs. So that told me it was a sucker's bet. And sure enough, you know, that's where we ended up the very next day. So if you look at that like that, that is the channel that we put ourselves in over that 3-day period. Okay. So opening up Sunday night into Monday, it's going to be very light volume, but I'm sure a lot of traders, especially futures traders, are going to be watching the markets. We'll probably have a down move in European markets and Asian markets because they kind of lag our markets by a day. So there'll be a reaction to that. And then Monday, again, no equity trading, but you'll see the EMini Futures trade. So what'll probably happen is the first thing I'm going to do is watch that low that we made on Friday. The odds favor taking that low out. It's going to be a choppy day because there's going to be low volume in the U.S. markets. But I want to see that we can take out that little downsloping channel right there. I do not think in this limited trading we're going to come up here and take out the highs made on Friday, you know, right around, you know, I guess I call it 19, 18 area. I don't think we're going to do that. And then the lows made down here on Friday, I think that's probably going to be more so challenged than anything. But what I'm also afraid of here is from an Elliott Wave count on this daily chart, you'll see here as we do this down, you know, we've got a perfect Elliott Wave setup here. Now that doesn't mean that it's going to continue to be that way, but you got a 1 leg, a 2 leg, and a 3 leg. Now the 3 leg doesn't convert. Remember, a 4 leg puts us up in this area right here. It's a counter trend roll. It suckers people in, and then it rolls back down for one final 5 leg. And then that 5 leg could put us down around my support area right there. So the question is, on this 4 leg up, it should be normal profit taking by shorts, not a lot of new longs in. A lot of people will be fearful. We get that roll back over, and then we get the final selling capitulation down here, and then we get, you know, one of these ABC chop patterns, and then we figure out where we want to go at the end of that ABC pattern. Typically, it'll go up like that, and then we get the divergences on the MACD, because the MACD will move up, it'll roll down, and then it'll move up like that. So you'll get one of these kind of looks like that, and it'll give us, that would be the ideal scenario for the position trader over the next 3 to 4 weeks. And that would put us down lower. And that would put us into this 1791 area, which, as you remember, is going to take us down from the highs around 15, 16%. Okay, so that means we still got another 4 to 5% to go, but not without a counter trend move. Now that would be this would be a better case scenario. Not the best case, but a better case scenario. A worst case scenario than this would be where we have this head fake and we move up, but we don't really get too far north. We get around 1950 area, and then it rolls back again. So we don't get that elevation, which then means we come down, we take out the lows right there that was made on Friday, and then this three leg just cancels out and moves over here. And that just further moves the Elliott Wave 5 down more from that 1791, which would then tell me that we're now looking at getting near bearish territory, bear market territory. So there's a number of things that we're going to be watching in the coming week or two on any potential counter trend. Okay, I want to see the counter trend get some elevation. Okay, I don't want to see if it rolls. If it starts to roll, we're going to be happy to short that roll. So we're going to be selling into it, but we're going to let it get some elevation first. Okay, if it starts rolling sooner, we're going to short into that too. All right, the sooner it starts rolling over on a daily chart, the more negative bias that I will develop on this chart. Okay, now the other case scenario is, let's say it does something like this. It could move up, print a 4, and then come back down, but not come below this, and start to bounce, come up, take out that prior pivot high, and come back up into this area here. If that happens, then we're going to have a recount of these Elliott waves, right? And I know Elliott wave theory can drive people nuts. I don't really care about Elliott wave theory. What I end up doing is looking at pivot highs and pivot lows as just one of the things I use to chart my course, along with Fibonacci, Gann, price and time series. So that's what we're using, what I'm using. So right now, that would be a more bullish scenario. That I would not give more than a 40% chance of right now. I would give more of a 60% chance that yes, we will have a counter trend, but that will be sold off. We will take out the lows made on Friday, and we're going to come down to this 1790 area, giving us about a 16% pullback. Now, the wild card in all this is what China does with the yuan. If they devalue very fast, or we get some shock to the system with Saudi Arabia and Iran, or we get some other shock with continued bad GDP numbers out of China and the US, then we're going to challenge this 1790 area and come down to what I described as a potential bearish market area, kind of the line of demarcation around 1700 in the SPX. Okay, so that's the way I'm seeing these markets right now. And if we just kind of take a step back out, you'll see all of these lines drawn on the chart. And you can see these potential points, these hold points that I've drawn for you, give or take a % or two, because my drawing skills using my mouse are not quite as good as they should be. But this is kind of where we are right now. So we're right at that level here. Again, I think we're going to have a little bit of a bounce. We're going to come down. We're probably going to test this 1791 area here. 1790, 1800, call it kind of a little price zone area around 1800. And then the next level down is around 1700. Obviously, you got to break one level to get to the next. So we're going to look at the break. We're going to look at the volume. We're going to look at the retest of that level. We're going to look at how the numbers and the Elliott waves are recounting to kind of show it. By the way, my system is saying right now, my system, not me, but my system is saying the Elliott wave 3 could carry us down to 1680. The Elliott wave 5 is going to take us down to around 15, let's call it 75 area, roughly. All right. So my system is forecasting worse than what I'm forecasting right now. But both of them are forecasting worse. So you guys need to understand that. Any move up, and we will get a counter trend move because markets don't go straight down, you get a counter trend move. Any move up you should use to reposition and reallocate your portfolio. Even that last October, huge bounce to the downside. We had a big move up, move down, bigger move up, and then we came down, we did a perfect retest, and then we were off to the races. We did not make a new high. We came down, we attempted it again. We started to form that downsloping channel, and then boom, away we went, right? And we broke that first channel. So I could see a minor retest up in this area right there. We got a little bit of a resistance point right there, and then boom, away we go, okay? So this, guys, it's not maybe the news you want to hear, but yeah, you can make money on this. I mean, you really can. If we come in and look at the 2-hour chart, we had some really great calls on the 2-hour chart here. I mean, we had these on the 2-hour chart, we had this, you know, this move down, then we had this bearish wedge, I guess, if you want to call it that. We broke down, and then we had another wedge right there. I'm not drawing it right. And then we broke down, and we're forming another one here. We may break down again. And until we get out of that cycle and we break up, then, you know, we're still going to come down. Now, that line right there was the lows made. Let me just back it out so you guys can just see a little bit clearer here and just kind of show you guys what we're going to be looking at on the SPX. And I'm using the SPX because a lot of people trade credit spreads. They're looking at where do you set your stops and things like that. But you can see we've already taken out the lows that were made back in August, the lows there in the SPX, not the futures, but SPX. Remember, the SPX only opens at 9:30. The futures went down into this area here around 1831. I'll show you that in a minute. But the SPX, by the time the markets open, it had bounced back up. We did a fairly good retest. Right here, we moved down, and then we quickly closed right back up into this area here. So we're in a zone here, a very solid support zone right now. And we're going to watch this really closely. It's around 1867 in this area. I do not have any divergences on here, just slight longer term like that, but we've got all of this noise in here, so that kind of negates, it doesn't give us an ideal divergence right there. So that tells me we're susceptible to more down move. Now, if we look at the divergences on a 2-hour chart, it does seem to indicate that we could expect a little bit of a bounce because we are oversold a pretty good bit. If we come in here and we look at this, you can see on the MACD, and I'll widen it out. This is a 2-hour chart. As you guys know, I love to use a 2-hour chart kind of x-raying in to what the daily action has given us. There's the channel like that, and you can see we made a low, a lower low, and a lower low. We're just kind of riding the bottom of the channel, and if this crosses back to the upside, boom, there's what we call a bud, a bullish divergence. So that would seem to say we're going to get a little bit of a bounce up at a minimum to the upper part of that channel. Then that'll be a key pivot right there around 1930, call it about 1935, and then we got another key pivot up in this area here, call it 1950. Okay, so we're going to be watching to take these out to get rid of this downsloping channel. If we just bounce up to this 1900 area, which is about the top part of the channel, and then we give it up again, that is going to be an area I'm going to instruct our members to start picking up shorts again, because we can expect us to come down and challenge this area. But this bud shows us a little bit of a divergence in the strength, which does say the probabilities favor a little bit of a balance. So, but in the overall direction of this traffic in this river, this is just a tributary, this 2-hour chart, the overall direction is still down, okay? Now, if we bounce over and look at the E-minis, or the EMini Futures, let me put it back on a daily chart here real quick, and I'm going to put all the indicators in. You will see right here on the E-minis, and let's just blow it up here. This is a daily chart. Let's make it weekly so it's a little bit easier to see here. You can see here on this weekly chart, let's take everything off. Right there, here is the level on the E-minis, 1789, right? The highs on the E-minis, roughly 2134 on the E-minis. I've got 2136, but the high really is 2134. So let me just correct that real quick. Let's come in here and let's make this high 2134. We'll get it exactly right, and then let's just close it down. So now we got this up here like this, and we can look at the E-minis, and you'll see a similar circumstance, right? On this weekly chart, if I were to just track, you know, what's the percentage move? We are right here we've come down that far. That was the low that we hit thus far, roughly, right? Let's get that off there. And then if I duplicate this, right, and then let's just move it over, and then let's just test this first line down roughly. If I were to test this first line down right there, that puts us right around 16%. I'm off just a little bit because, again, my drawing. And then if I were to duplicate it again, and this is the futures market, right? So the futures market trades 24/7, and that's my preference to trade. You'll see it's coming down like that. So roughly, now in the futures market, if we hit the 1787, 1800, it's about a 16%. If we come down to hit 1573, that's 25%. Bear market territory in the futures market, folks, is right here. Let me just move it over. I'm doing this real time on my chart, so I'm just going to draw it in for you. Let's see, right about, geez, let's get it in here a little bit better. You think I've been drinking bourbon all morning. I'll just leave it, right? I'll leave it at 20%, 20.12, but around 1700. So about the same. 1700 puts us pretty much in bear market territory on this chart as well, okay? So now on the E-minis, you can see back in August, if I were to draw this line in here, that was the lows made right back then. 1813, this was made back in October 2014. And then here is the low made right there, 1831. So if I were to blow it up, these are the ones I'm going to want to watch for right here. These are the key lows. So we do have some resistance points below us. Will they be strong enough to hold up? I'm not really sure at this point in time. But just like I'm not going to go through this again because it's going to be the same on the E-minis as it is the S&P 500. But these are the key levels, all right? 1831, 1813, and then that 1787. If we come all the way down to here, that still keeps us in correction territory around 16% from the highs, okay? All from the highs made last summer at 2134. All right, so that's kind of where we're sitting. The 1700 roundabout number that defines whether we go in bear market or not. Again, I'm going to say this again with this one, just like I did with the S&P 500 cash index. No one knows where the market's going to go. It will be choppy. I'm going to expect a bounce. We could get something like this, and then we just, boom, give it up. And next thing you know, we're already down here at 16%. This is the worst start to the year. I don't need to tell you that, but you already know that. Now, notice the count on this weekly chart is an A, B, C instead of a 1, 2, 3. That is a good sign, folks. That means that at least on a longer term basis, we're not probably going to give it up all the way down to here, okay? We're probably going to stay somewhere in this very wide range here, anywhere from 13% to less than 20% down. Now, I know it's a very wide range, but I don't see at this time the U.S. going into a bear market territory. Okay, if we come back into the daily chart here, you can see kind of where we're sitting. Remember in the SPX, we actually took out our prior lows, right? SPX was down in this area here. Here, that's 1831. That was the August flash crash. And then the markets open, the SPX opened up in this area here. So we already came down. So this is going to serve as a lot of support. A lot of black boxes just, cut sells right there. Sell programs just instituted, and then when it came down there, buy programs started coming back in. Now the question is, will buy programs come in back down in this area here? Remember, this area here, it's a different time frame from that area right there. We've got right now the S&P's got a go forward PE ratio of around 15.7, which is around the longer term average. When we were up in this area here, we were around 19 PE ratio. So all the markets have been doing is just kind of adjusting their portfolios to drive the prices down to get the PE ratios more in line. If we start getting worse economic data, guess what? They're going to take that PE ratio down into the 14s. And if they do that, that's going to drive the price down to that 16% level that I showed you before. So that's all we're seeing right now. We've only had just a couple of scare the children moments in the markets. But this is kind of where we're sitting right now in the E-minis. Now, one other thing I will show you, and then I'm going to call it for the day. If we look at our VIX, now on our VIX, notice I color code my chart. And I've got basically, and I use this for strategies, you know, and these are different zones of the VIX, right? These are my zones. And then this right up here is Star Wars Black Swan zone up there. Okay, so when we're down in zone 1, I use different strategies than when I'm in zone 2, zone 3, and zone 4. All right. If you're not a member of our group, I highly encourage you to come on in and sign up. We're doing a lot of really cool things. And we use this stuff because if you're an options trader, if you don't understand volatility, you're screwed before you even start. Okay, you really are. And that's not to say that if you have a firm understanding of volatility, you're not going to take it in the shorts every now and then. You always do. But at least you put the odds in your favor for the strategies you pick as you move up in VIX, right? So right now you can see in our various zones that we're in zone 3 right now. And odds favor from a zone 3, we're subject to spikes into zone 4. When you get into zone 4, you know, this is a what I like to say, and I hear other people say the same phrase, which is cool, but what I call it scare the children. You know, that's when you start to get into the bomb shelter, right? Kids are afraid, traders are afraid, right? And that's kind of where you go right there, scare the children. But you want to start planning for it, not when you're up in there. When you get into zone 3 is where you want to start prepping for this, right? When you're in zone 2, you start prepping for zone 3. Because the way volatility works, even last August when we had the biggest pop in volatility on record, now that didn't mean it went higher than 2008. Volatility was higher in 2008 than it was here. But over a 3-day period, we started off down here in zone 2, and we went all the way up to zone 4 in 3 days. That is very unusual. You can see here we started in zone 2, we went to zone 3, we went to zone 4, all the way up to zone 5, which is the black swan hole up in there. That's why I leave it black. That was the largest percentage-wise move in volatility we've seen. That's why they called it a flash crash. So typically, outside of black swan events, you generally steadily move from zone 2 to zone 3. From zone 3, you're subject to spikes to zone 4. So you want to trade this based on what zone you're in, okay, if you're an options trader. So again, if you don't really understand it, I'd come on in and join our group because it'll help you out, especially at times like these. Now, the other thing that we're tracking clearly is the bond market and the currency market. There's going to be some great trades in bonds and currencies this year. We're also in gold and silver, and we're looking at oil, and they seem to be hitting the numbers that we're calling out. So I would highly encourage you to check us out if you're not on our site. Otherwise, I spend a little bit longer time than normal on this weekly update, but you know, it's important that you understand how these markets move and why they move the way they do, okay? So just to reiterate, I pointed out the keys here. I will expect a little bit of a roll up, right? I don't know if it's going to happen Tuesday or Wednesday, but we're going to get a counter trend move, maybe 2 or 3 days of a counter trend move. Surprise, surprise. And then we're going to be ready for a rollover. And in that rollover, because we will get it, not guaranteed, but you generally have a counter trend to the counter trend, right? And that rollover, we're going to watch to see where do we stop. And where we stop is going to pick out and plot our pivot highs and pivot lows and just what is the next week going to bring us. If you'd like to get more detail on this or follow us in our chat room where I put these things out on 5-minute, 1 hour, 2 hour, and daily bars, then I highly encourage you to come on and sign up. Otherwise, that's it for me. Have a great weekend, everybody, and I will see you guys later. Ciao, everyone.